Fourth. All right, welcome everyone, welcome. So we are here today to do our third resident tax training session. So just to kind of remind everybody, we are most of the way through the fall training. We're still waiting on the IRS Link and Learn system. Hopefully it will be live any moment now. But for us today, we're going to talk about credits, education benefits, and finishing the return. I'm also going to give a little bit of updates on Moodle, go through a little bit in practice lab to show you kind of where some of these credits live. And then also we're going to go through a couple of Dear Iris questions for fun. So just a couple of updates on Moodle. So I add people as people complete the volunteer data. It's really a survey, not really a quiz. But so I add people there. You're added, not at the first moment. That's totally fine. So there are 5 modules and quizzes that should be done. So 1 to 3 from the prior week or from 2 weeks ago, and then the income and then adjustments and deductions quiz. That's kind of theoretically where you should be on this. And I would say that generally most people are doing pretty well on it. Really the folks that are struggling are, the area that they're struggling is filing status, which is very tricky. I will freely admit that it is not easy to determine the filing status because, sometimes there can be a couple of options. So trying to figure out what is going to be the best, or, does somebody have a dependent or not, which is also can be tricky to determine. So the filing or the tables and like the flow charts in the 4012, those are kind of there to try to help you work through that. And remember, you don't have to memorize any of this stuff, right? The 4012 is going to be there for the tax test. It's going to be there for the tax clinic. Yes, right now it doesn't include the OB3 information, but that will get updated. So, it is definitely a place that you should feel free to use as a solid reference. All right. So a quick review of last week. So we have our general tax equation, right? We're going to see this a couple times. We started off with income, right? All of the income gets added in. We subtract adjustments, deductions, and exemptions, right? These are money off of your taxes based on money that you've spent or people to find your taxable income. Then you take that times the tax rate to find out what your total tax is. From that, we're going to get into the stuff we do today, which are credits. So we subtract credits from the tax amount. So it doesn't reduce your income. This reduces the amount of tax that you owe. And then we would subtract as well withholding and estimated payments. So like money that you've already sent to the government for taxes. And you find out, do you get a refund? Is today a great day? Or do you owe money? All right, so these were kind of the main income topics that we talked about. Right, really the big ones that we're going to see a lot of: wages, salaries. We're going to see a lot of scholarships. We're not going to see a lot of interest, dividends. Definitely not going to see a lot of IRAs or Social Security benefits, although those are on the test. We won't see generally any alimony received or rental income, farm income. Those are out of scope. There can be taxable state refunds, although they're not very common. There can theoretically be some business income, although it's relatively limited. We're not going to see a lot of people that have a lot of independent businesses at our tax clinics. When we think about income, right, there's a few things that are new this year, right? This no tax on tips, which is really just like a reduced amount of tax on tips. Basically, there's starting to be a little bit more guidance about how to figure out what this number is of how much are my tips that I can put into this adjustment. Likewise, there is this no tax on overtime. We're starting to get some feedback on, okay, how is this going to work? It again looks like there's not going to be, particularly for the overtime, it won't be official information on the form W-2, but there may be some additional information that employers provide. Otherwise, our clients are going to be needing to figure that out. Hopefully, again, most of them won't be, right? Because as mostly international students, or even as US citizen students, right, they are going to school for a time. So they're not going to have the capacity to go to school full time and work more than 40 hours in a week. So we will see that when we get there. So we have our income, then we subtract adjustments, right? And those include things like the educator expense, which doesn't really change for 2025, but will for 2026. penalties on early withdrawals of savings or alimony paid for qualifying alimony payments, IRA contributions, student loan interest adjustments. There can be a few other additional adjustments, though those are not very common. Self-employment tax, health savings, and then finally this one that we maybe will see, right? This new tax, no tax on new car loan interest. A mouthful to say for anybody. All right. We also have our deduction amounts, right? So we have income minus adjustment minus deductions. Standard deduction is a set amount based on your filing status. There's some extra amounts depending on whether you're older or if you are visually impaired. You can take either the standard or the itemized deduction, right? Whichever one is best generally. There's a few places where you have to itemize, but mostly people can choose, and it's okay to choose which one is best. Here are those numbers again, right? Those numbers changed versus what does your 4012 say? So make sure when you're looking at those, when we have questions, make sure you're using those correct numbers. There's a new senior deduction, which basically reduces their income even further. It's based on age only. It's not based on whether you are receiving Social Security benefits or not. It does phase out if your income is high enough, but basically it was supposed to be like a no tax on Social Security, but it ended up being extra money off if you're older. All right, for itemized deductions, right, these are things that you spent money on that you can subtract from your taxes. Those are things like medical and dental expenses, if you have enough of them, if they're over that 7.5% floor, state and local income taxes and property taxes. And the big news here, right, is that limit changed. It used to be $10,000, now it's $40,000. So that's a really big increase. So theoretically, maybe there would be somebody we would see in that situation. Home mortgage interest and gifts to charity also can be deducted, as well as certain miscellaneous losses. I'd mentioned gambling losses and a 90% deduction there. So that actually is in 2026 and later. So it's not for 2025. So for 2025, basically, if you have gambling winnings and gambling losses, you can subtract your gambling losses, but only up to the point of your gambling winnings. And in the future, you can't even subtract all of those. You're only going to be able to subtract up to 90% of your winnings. So you're going to still have some gambling income if that applies to you in the future. All right, that was super quick. Does anybody have any questions on this before we kind of jump into the new material for the week? Okay. All right. Let's move on then to credits. We're going to talk about credits today. So remember 50 years of social or 100 years of social engineering, get married, have some kids, will give you money off your taxes. Credits are the primary way those benefits are delivered. Yes, there are deductions and adjustments, but credits are kind of one of the big money back items for how the government provides benefits to its taxpayers. So we're going to start off with the concept of refundable versus non-refundable credits. So these are kind of two different high-level categories. So a non-refundable credit reduces the amount of tax that you owe dollar for dollar. So if you owe $100 in tax, if you have a $100 non-refundable credit, it will reduce your tax down to zero. That means that if you don't owe any tax at all, then there's no benefit for a non-refundable credit, right? Because if your tax is zero, you can't go down any further. Generally, the credits are applied on the federal income tax, kind of on the order that they're listed on the Form 1040. So there is sort of an order like try this one, this one, this one, this one, down and so forth. The software will handle that piece. We don't really need to worry about that. But just know that they only can take you down to zero. All right, so let's look at what an example of this would be. So let's pretend there's a taxpayer named Chris. He's got a federal income tax that he owes of $470. So he meets all of the requirements to claim a $500 credit for other dependents and a $100 retirement savings credit, which we'll talk about those in a little bit. So he's got $600 of non-refundable credits, which is more than the $470 that he owes. He can claim $470 for the credit for other dependents. His tax is down to zero. That last $130 of unused non-refundable credits basically just goes away, right? He doesn't get to use it. It doesn't go anywhere. It doesn't help him. He doesn't get any money back. It's sort of wasted, you could say. But at the same point in time, right, all of his tax went away. He doesn't owe any money. So Chris is moderately happy about that. So let's start with tax credits that are non-refundable. And the kind of the biggest one that is very, very common at VITA sites is the child tax credit. So it's a non-refundable credit. The child tax credit is non-refundable. A social security number is required for at least one parent. That's a new change. The maximum credit is $2,200 per qualifying child. And starting next year, they're going to increase that annually by inflation adjustment. So $2,250 or $2,225, who knows what the number will be next year, but it'll be incremental adjustments. Taxpayers who cannot use the maximum non-refundable credit may be able to claim the additional child tax credit. So it's kind of weird. Basically, the child tax credit is a non-refundable up to $2,200. But if you can't take that, there's something called the additional child tax credit, which is a separate credit, but it's essentially like the backup plan, so to speak. And that says, well, if you can't use all of that child tax credit, the additional child tax credit, which is smaller, but that is refundable. So that can also reduce your tax as well. On the credit, you use Form 8812. That basically collects some information about who this child is, how many children you have, about your income, about the support you provide for the children, and then it does all of the math for determining the actual amount of the tax credit. So to be a qualifying child for the child tax credit, you have to meet a bunch of criteria. So, and this is different necessarily than what the criteria for being claimed as a dependent or a qualifying child for dependent purposes. So a lot of these tax things that we're going to do, the criteria for them, the credits, is slightly different versions of the same thing. So there is an age requirement. You have to be under age 17 at the end of the year. You've got to be a US citizen, national, or resident alien of the United States. You have to meet a relationship test, which I'll show you in a moment. You have to be claimed as a dependent by the taxpayer, except there's a few special circumstances for divorced or separated spouses. So they would have to basically have a legal agreement that says, hey, odd years, I get the children, even years, you get the children, or some other criteria for determining it. The child can't provide over half of their own support. They must have lived with the taxpayer for more than 6 months of the year, although there can be exceptions for like short-term absences and things like that. And then the child must have a valid social security number as well. For the relationship test, so they have to be related. Think of it as out and down. So they can be your son or daughter, adopted or stepchild, eligible foster child. They can also be your sibling or your half sibling or your step sibling or a descendant of them. But you can't go up. So it can't be parents or uncles or grandparents or anybody kind of like up the family tree from you. All right. Credit for other dependents. So if you don't meet the criteria for the child tax credit, there's a possibility that you might meet the credit for other dependents. This credit is also non-refundable and it's smaller. It's only $500 versus that $2,200. So it's a pretty big difference there. You can't claim the credit for other dependents if you are eligible to be claimed for the child tax credit, which kind of makes sense, right? It's why would you choose the bad one if you can have the good one? The dependent for the credit for other dependents, though, there's more flexibility. They can be a qualifying child or a qualifying relative. They can have a social security number or they can have an ITIN number. And they must be either a US citizen, national, or resident alien of the United States. So this is definitely one that we would see more of with individuals where, let's say that they were an F1 PhD student, they brought their family, their spouse, and their children with them on F2 visas. Once that primary visa holder and the secondary visa holders, they become resident aliens, then their children would also be residents, most likely, And then they might get an ITIN and be able to get this credit for other dependents on their tax return. All right, so let's do a quick knowledge check here. So we have Francine, who's 43. She's divorced. She earned, I forgot to update that date. Sorry there. She earned $43,000 in 2025. She supports her widowed mother, Connie, and her sons, Henry and Neil. All of her sons and her mother-in-law lived with her in Chicago. Their sons don't provide any of their own support. So everybody has social security numbers except for Francine and Henry, who have ITINs. All right. Who can Francine claim for the credit for other dependents? Can we claim Connie? Theoretically, yes. Connie would be eligible, right? She is Francine's dependent as a qualifying relative. She could claim Henry as a qualifying dependent or qualifying for the credit for other dependents. But she wouldn't be able to claim Neil because he has a social security number, he's 12, and he's a qualifying child. So he would be eligible for the child tax credit. All right. And then the fun thing now, which I also need to update, right, is that I believe, and I will confirm, the child tax credit, at least one of the taxpayers who's claiming the credit must have a social security number. And in this example, Francine has an ITIN. So theoretically, with the example as written, it doesn't work. So we have to change it to say only Henry has an ITIN. Everybody else has a social security number. All right. There we go. And then, yes, we will leave how in the world that could happen for another day. Okay. All right, so moving on. So have some kids. We'll give you some money off your taxes, right? The child tax credit, the credit for other dependents, provide tax credit, a tax reduction to people that support children or support other dependents. Now, they also have a thing called the credit for child and dependent care expenses. And the idea for this is that if you are working and you have young children and you have to pay somebody to look after your children while you work, you can get a credit for some percentage of the amount that you spend on those child and dependent care expenses. So it's based on a percentage of how much you spend. So you don't get, like I spend $1,000, you don't get $1,000 in credit. You would get somewhere between 20 and 35%. So $200 to $350 as a credit. Starting in 2026, the percentage is going to go up, which is going to be great. It's going to be somewhere in the 35 to 50% range. So that's really good. There is a maximum amount for the credit. You can claim up to $3,000 for one qualifying person or $6,000 for two or more. So it doesn't go up. So if you have 3 children, the max is still $6,000. The cool thing here is that the expenses don't need to be allocated equally across qualifying people. So if you remember when we did that teacher educator adjustment, right, it was like $300 of educator expenses per person. And if one person spent more and the other person spent less, you couldn't like add them up to still be under that 300 plus 300. It had to be 300 from one maximum, 300 for the other maximum, even if it ended up being less. Not the way it goes here. This one, basically, it can be higher. Now, the criteria are different as well. So there is a different age criteria. Basically, children under age 13 are eligible. If a child turned 13 during the year, the expenses from before they were 13 would be eligible, but everything else afterwards would not be eligible. This also can be for a spouse who is unable to provide their own self-care or a dependent who is unable to provide self-care. So there's a form, right? This is the IRS. They have a form for everything. So that form is called 2441. Basically, it collects care amounts and figures out the credit for you. There's also information that you have to have about like who you paid for that care. So the other thing to know, right, is that the IRS is always very worried about like double dipping or people trying to get around things. So you can't pay money to your spouse or to a child under 19 or to the child's parent. Maybe you're separated and you can't pay the child's parent or another dependent, and claim those expenses for the child independent care credit. So that's basically kind of like saying, oh yes, I'm going to pay somebody and get money off, and then kind of cheat the system essentially. All right. So there are 5 tests for this. Basically, they have to be a qualifying person. You have to have earned income, right? The whole point of this is that you're paying somebody to take care of your child so that you can work. You have to have earned income to do this. There is an exception for a very small amount, like I think $200 or $300 a month for going to school full time as well. There must be work-related expense tests, so the care must be to enable you to work. So it's not just that you have them take care of the child while you're not working. It's got to be for when you're working or looking for work. If you are married, you must file a joint return. And then you also have to provide information about who gave the care, right? And this is where the IRS starts to double check things, right? They say, okay, Maria's daycare took care of this child. I have to provide my information, my tax ID number, my address to the parent that I gave care for their child to. That parent reports that they paid me, $1,000 to take care of their child. They get credits. And then I have to report that as business income, right? Because I am getting paid to take care of the child. And so this is one of the ways that the IRS basically tries to double check on both sides. Is everybody reporting all of the income properly? All right. So let's do another quick check. So this is Chantal. She's single. She works full-time as a data entry clerk. She has 2 children, Alex and Ashley. So Alex is 3. He goes to daycare while Chantal works. Ashley is 7 and stays in school after care until Chantal finishes working. So Chantal paid $7,200 for Alex's care and $1,800 to the elementary school for Ashley to go after school care. What is the maximum amount of expenses that Chantal can claim for the child independent care credit? All right, so the options are A, 3,000, B, 4,800, C, 6,000, and D, 9,000. So everybody think of your answer. And the correct answer is 6,000, right? So this is not like that educator expense adjustment, right? This is where she has 2 children, so the maximum is 6,000, even if there is more spent on one versus the other one. So that is one of the nice flexibility things about this credit. All right. Next, we're going to talk about the credit for the elderly and disabled. So as far as I can tell, this credit still seems to exist. So we have the regular standard deduction, and we have a little bonus if you're over 65 for the standard deduction. And now we have this new fabulous, wonderful additional deduction for the elderly. If you're over 65, you get $6,000 off. Now we also have a credit for the elderly and disabled. So there's obviously, right, lots and lots of benefits from a tax perspective to if you are over age 65. All right. So basically it's a non-refundable tax, right? So again, it's not going to reduce your, it's not going to give you a refund, but it'll reduce your tax down to 0. If the taxpayer is not over age 65, but they're permanently and totally disabled, they will have to have a physician statement. They don't have to send it in with their return, but the IRS may be likely to ask for it. So they would send a letter saying, hey, please provide us your documentation on this. And then the taxpayer would need to send that in to the government. There is a Schedule R that is used to claim that tax credit, and the form kind of confirms the eligibility, certify that they have the physician statement, and does like all of the math for calculating the credit. All right, so who's eligible? So you have to be a citizen or resident alien and either 65 or older, or if you're under 65, you have to be retired on permanent and total disability, receive taxable disability income for the year, or on January 1st had not reached a mandatory retirement age. You must have income below certain adjusted gross income and non-taxable income guides. So for example, those limits are below AGI of 17.5 and with non-taxable income of below $5,000. So the 4012 page G26 has the criteria for the other filing statuses, right? And you can see like this is a really narrow window, right? Because our standard deduction is like what, 15,750. So, and to have AGI below that, right, we're really not talking about a lot of money here. The other thing is that the taxpayer cannot be married and filing separate if they have a spouse that lived with them. So again, seems to be unaffected by OB3. All right. Generally, the software is going to calculate something like that for us. We're not going to have to do anything other than if an individual was on permanent and total disability, they would have to indicate that in the software, and then it would ask some additional questions to make sure that they were eligible. We could fill that out. All right, let's talk about retirement savings, right? Although most of our clients are college students, it's never too early to start thinking about retirement savings. So it's a non-refundable credit to encourage people to contribute to retirement accounts. It's also called the Savers Credit. So one cool thing here is that you have extra time to make a contribution to this account and qualify for the credit. Although most things really only matter from January 1st through December 31st. For retirement savings contributions and this credit, you can make a contribution up until April 15th of the following year. So April 15, 2026 is when the returns are due, and that's how long you have to make that credit. That credit is claimed on Form 8880. It basically collects some retirement account contribution amount information, if you had any distributions, and then figures out the amount of the credits. So who qualifies for this, right? You have to be older than 18, which most of our people will. But the kicker, right, is that you cannot be a full-time student. So if we see any of these, we want to make sure we double check, is that person a full-time student? It's possible that they might not be, right? We have a bunch of postdoc researchers, right? They've got their PhD, now they're working full-time doing research. Those individuals would definitely, potentially qualify for this. But otherwise, if they're still a full-time student, they're not going to be eligible for it. They also cannot be claimed as a dependent on another person's tax return, and their income must be below certain AGI limits, and those limits are pretty low. All right. Qualified retirement account contributions of up to $2,000 may give you a credit of up to $1,000 of tax reduction. So it's non-refundable. It's not money back in your pocket, but it reduces your tax by up to $1,000. And if you're married filing jointly, it kind of doubles those amounts. It's based on a percentage of your contributions, and it's based on the percentage is based on your filing status and your income as well. If you had distributions from a retirement account in the past 3 years, that can reduce the amount that you are able to claim for the credit as well, right? You can't just like take the money out and then put it in and get a credit and then take it out again and then put it back in again. The IRS frowns on that kind of game playing. So that's the Savers Credit. Theoretically possible, we could see a few of them, but not very likely. All right. There are a lot of different types of eligible retirement accounts. So traditional IRAs and Roth IRAs, 401ks, 403bs, simples, all of these ones. Usually university, if somebody's working for a university, they would have a qualified retirement plan that would be eligible. Generally, if they have something like this, it's going to be listed in box 12 on their W-2. And I can't remember what the specific letter of it is, and it depends on whether it's a regular, like traditional IRA or a Roth IRA. They use different contribution codes for those, or 401ks, but that's where those codes would be. So if you see numbers in box 12, letters and numbers, you are going to need to make sure you enter all of that information. Other taxpayer records would be needed if it was not a plan that was through work. So for example, if they just opened a retirement account through a brokerage, then they should be able to get a statement from their brokerage account saying, hey, congratulations, you made a $500 contribution to your IRA during 2025. Okay, so that is the end of the non-refundable credits, right? So those credits will take us down our tax, it will take it down to zero, which is great. It's wonderful, right? We love to not have to pay any tax, but it's even better, right? If we don't pay any tax, they give us some money back, right? So this is like extra money that you get. So you don't pay any tax and the government gives you some money as well. So this is, right, this is the stuff where people get excited, especially our clients get excited. All right. So a refundable tax credit is considered a payment made by the taxpayer, so they can reduce your liability down to zero, pay for other taxes, and then if your tax is below zero, you can get that extra back as a refund. Some taxpayers will have no income tax owed, but they are going to be eligible for refundable tax credit, so they should file a return, even though they're not required. They don't, like they're below the standard deduction, they don't have to file. They didn't have any tax withheld, so they're not going to get a refund of any tax withheld. But if they're eligible for a refundable tax credit, they should file, right? Because they are going to get some money back, and we love to see that. So let's do an example. We have Jeremy. So Jeremy has a federal income tax amount that he owes of $2,800. He can claim a $2,200 non-refundable child tax credit and a $1,500 refundable earned income tax credit. So his total tax credit that he qualifies for is $3,700. And that is more than his income tax of $2,800. So Jeremy can claim the full amount of the child tax credit, which reduces his tax down to zero. Jeremy can also claim the full amount of the earned income tax credit, which reduces his tax liability down to zero, and then pays the remaining $900 as a refund. All right, so we have $2,800 that he owes. We subtract $2,200 to get $600 left in what Jeremy owes in taxes. He's got $1,500 of earned income tax credit. So we subtract that $600 from his earned income tax credit. That's the zero mark for his tax owed. Then he has $900 left of that earned income tax credit. So he gets $900 as a refund. So that's kind of how that works. And it is nice, they subtract all of the non-refundable credits first, and then they subtract the refundable credits. So if you had, let's imagine Jeremy's tax was $2,000. In that case, if it was $2,000, his non-refundable tax credit would be $2,200, but he can only use $2,000 of it. That takes his tax down to zero. That means that he gets that full $1,500 back as a refund because that earned income tax credit is refundable. So that's kind of how those numbers work together. So the first one on this is the additional child tax credit. Remember I said that there was like the child tax credit, which is the main credit. Then there's kind of this backup plan. It's a different credit, and it's the additional child tax credit. And it basically says if your full child tax credit can't be used, some portion of it, if there's some of it left, can be refunded to you as a refundable credit, but not the full amount. So the qualifications for this basically match. So the same additional child tax credit qualifications as the child tax credit qualifications. It looks like there is one little change. To claim the additional child tax credit, you must have more than $2,500 of earned income. It used to be that, or have 3 or more qualifying children. Now it looks like it's just you have to have some amount of earned income. Again, that credit is claimed on Form 8812, which basically uses some information about your children, how much tax you owe to figure out how much is the refundable amount, how much is the non-refundable amount. So for example, do I have an example here? Yes, I do. Okay, that's good. So let's pretend Jeremy, pardon me, I'm going to sneeze. Excuse me. So Jeremy has federal income tax of $400 that he owes. He can claim that full $2,200 non-refundable child tax credit. So the amount of credits that he qualifies for is $2,200. It's higher than what he owes is $400, right? So he claims $400 of child tax credit, which reduces his tax down to zero. He has $1,800 like left over, right, available from the child tax credit / additional child tax credit. Now, only $1,700 of that $1,800 is refundable. So Jeremy gets a refund of $1,700, but $100 just basically gets wiped away, right? It never gets used because that portion of it is only non-refundable. That first $500 is non-refundable for the child tax credit. All right, the big one, the earned income tax credit. All right, so the idea for the earned income tax credit is basically to help low to moderate income taxpayers, particularly those with children, to kind of give them a financial supplement, to give them help if they do not have a lot of income, but they are working, they're earning income, they're doing their best, they just, for whatever reason, their job, their situation, they just don't have a large amount of income. So the two main factors that are based that determine the amount of the earned income tax credit are how much income you have and your family size. So when you use that, you're going to use Schedule EIC, which basically collects some information about the number of children that you have that are eligible. You don't have to have a child to be eligible for the earned income tax credit, although there's some different criteria if you don't have any children. So, all right. The earned income tax credit is, because it's a refundable credit, because it can be a large number, right? It can be $5,000, $10,000, depending on how many children and how much income you have. It is also a credit that is subject to a large amount of fraud. And so the IRS does pay attention to people that claim the earned income tax credit and does take additional steps to verify that those people are eligible for that credit. If they try to check on your earned income tax credit and it turns out that you were not eligible, they will disallow that earned income tax credit. If they disallow it for you in a prior year, for any reason other than just like you did the math wrong or a clerical error, and you want to try to claim it again, you have to fill out what's called a Form 8862 that basically says, yes, once upon a time, I claimed the earned income tax credit when I was not supposed to claim it, but this time I am claiming it because I am eligible and I've met the requirements to now claim it again. If you claim it without being eligible and it not being a math or a clerical error, you will be banned from claiming it again for a period of time. So if we have anybody with the earned income tax credit, we want to just double check to make sure that they are truly eligible, because it can haunt them for a long time if they claim the credit when they're not supposed to. All right, so the maximum credit is, I guess I said 10,000, but that was not true. Let's try $8,000. So based on your filing status and the number of qualifying dependents that you have for the child earned income tax credit, purpose, there are different income limits, and there's an income limit on investment income, and then the maximum amount of credit kind of varies as well. And you can see, right, this is really intended for people with children, because if you don't have any children, your maximum credit is like $649, and your maximum income is, $26,214. Whereas if you've got 3 or more, hey, you can have a credit of $8,050 roughly, and income of up to almost $70,000. So it really does kind of go into that low to moderate income range once you have children and would be able to qualify now. So to be eligible, the taxpayer now, they have to have earned income. They have to be a citizen of the US or a resident alien for the entire year. They have to have a valid Social Security number for themselves, their spouse, and any qualifying children by the due date of their return. So like if they have a child, they need to apply for that child's social security number right away. Investment income cannot exceed $11,950. They can't use married filing separate status unless they lived apart from their spouse for the last 6 years and they have a qualifying child. So that's basically like the head of household criteria. They can't file Form 2555, which is for foreign earned income exclusions. If they don't have any qualifying children, right, and this is where we're going to see a lot of our students fall into this bucket, right, because they're college students. Most of them don't have children at that point in their lives. If they don't have any children, then they must be at least 25 years old. They also can't be a dependent of another person. They can't be a qualifying child of another person. And they must have lived in the United States for more than half of the year. So this means that generally most undergraduate students are not going to be eligible. PhD students may or may not be eligible depending on how quickly they've gone back for their PhD program. Most, people that are working, teachers, staff, researchers, just general public, they will probably be old enough to meet that 25 years of age to be eligible for that earned income tax credit. So that's the criteria there. All right, so to be able to claim a child for the earned income tax credit, so they have to have a specific relationship. So they have to be son, daughter, adopted child, stepchild, foster child, or a descendant of any of those. Your brother, sister, half-sister, so on and so forth, descendant of any of those. The child has to be younger than you and younger than age 19, or younger than you and younger than 24 and a full-time student, or any age and permanently and totally disabled. The child must have lived with you for more than half of the year, and they can't file a joint return. So let's talk about earned income for just a second, right? So because this is called the earned income tax credit. So you have to earn income to be eligible for the credit. So this is going to be income that you essentially receive for work. So it includes work that you do as an employee, which you get reported on a W-2. It could be earnings from operating a business on like a 1099 NEC or 1099K or other cash income. Some union strike benefits qualify as well. It is not going to be income that's earned from things like interest, rental income, investment dividends or capital gains, unemployment, workers' comp or pensions. Scholarships and fellowships are not going to be considered earned income as well, I believe. All right. There are some types of income that don't involve direct work that the IRS classifies. So these things can include some of these other types of things, such as inheritances. So I'm kind of repeating myself here. So basically, there's a pretty limited subset of the types of income you can receive that would count as earned income. And it's really kind of stuff that we traditionally think of as earning income, right? You go out there and you work, you have a job, whether it's a job for yourself or a job for somebody else, right? You do things and somebody gives you money for it. All right. Next credit we're going to talk about that's a refundable credit is the premium tax credit. So basically, the premium tax credit is a credit that some taxpayers get that helps them pay for insurance that they buy through the Affordable Care Act. This is an area that requires advanced certification. And the idea, right, is that an individual wants to get health insurance, needs to get health insurance. They purchase insurance from a federal health insurance marketplace or a state-based exchange. Qualified taxpayers can receive a subsidy for paying for their insurance. And it's based on their income and some information about their family. And it's an estimate. So when you sign up for the insurance, you say, oh, I need insurance and I think I'm going to earn $12,000 next year. And so that system calculates and says, okay, Maria, based on this insurance that you're going to choose, like the cost of it would be $500 a month, but we're going to give you a credit, a premium tax credit of $400 a month. The government's going to send that $400 a month straight to the insurer. You're going to pay $100 a month, and then you're going to have health insurance for the year. All right. Now we get to the end of the year, and we basically have to do some math to say, oh, Maria, you said you were going to earn $12,000. How much money did you actually earn? If you earned more money, then you shouldn't have received all of that credit, that premium credit that we sent to the insurer on your behalf, and you have to pay some of that back. Likewise, if you get more money than you, or if you earn less money than you thought, you can get additional premium tax credits that you wouldn't have had to pay that money for your insurance, because I thought I was going to earn 12,000, but I only earned 6. So I really should have only paid $50 a month instead of 100. That would be my premium tax credit. So who qualifies for this, right? So the person must not be eligible for an employer-sponsored plan or covered through other family members, employer-sponsored or government-provided plan, such as Medicare, TRICARE, or CHIP. So Medicare is generally older age, TRICARE is military, CHIP is Children's Health Insurance Plan. The taxpayer must purchase health insurance through a state-based or federal marketplace in states that don't have exchanges. Their income has to be between these limits, 100% to 400% of the federal poverty guideline. And there has to be family size limits as well. They also can't be married filing separately unless an exception for spousal abuse or abandonment applies. Now, one of the bad things here, right, is people who are above the 400% may or may not have to repay some or all of their premium tax credit. Starting next year, they're going to have to pay the entire thing back. We are generally not going to have to do the actual math on the calculations, but here's a little bit about how it goes. So basically, essentially, like how much you have to pay of the premium is based on where your income falls in that the FPL, so the federal poverty level, which is based on your family size as well, essentially. So a federal poverty level for an individual who's filing single would be less than somebody who is filing a joint return and has 2 children. So this year, basically there are percentages where it's up to a certain amount and then it's capped. Starting next year, there's going to be, if you're over the 400%, there's no subsidy and you're going to have to pay everything back. And then next year as well, right, everybody's going to have to pay something for health insurance through the marketplace. At least that's what the current law says, right? It's possible that it's going to change by the time we get to 2026, but for now, at least, that's kind of where things stand. Okay. So somebody that has health insurance through the marketplace should receive a form 1095A. So in that letter A is important. The A basically says that it's through the marketplace. A B or a C means it's going to be coming from like an employer or through like the university or something like that. That form would show who is covered by the policy, the cost of the policy. There's this kind of reference number that's the second lowest cost silver plan amount, the amount of the premium assistance that was already paid, and then the months that the person was insured. The form 8962 is used to figure the credit. You enter all of the information from the 1095A and does all of the calculations to figure out, do we have to pay some back or are there some additional credits that you might get? So if a 1095A appears to be unusual or missing, or if there's multiple forms, you can see publication 4012 for guidance as well. Unfortunately, this is also an area that has been subject to fraud, particularly a lot last year. This is actually one where the taxpayers are not necessarily doing anything wrong, but there are some insurance brokers that basically get paid on commission when somebody signs up for a marketplace plan. And so These insurance brokers are fraudulently signing up taxpayers for marketplace plans, right? They're pocketing their little commission. The taxpayers have no idea about these 1095A forms, right? They never receive them. They have no idea that this is going on until usually they get into the tax return and they try to submit their return and it gets rejected or they get a letter back from the IRS. So in that case, we can provide some guidance for them to try to start working through that issue. But it is an area that there is definitely fraud that is not the taxpayer's fault, right? It is these brokers that are acting in bad faith that are trying to fraudulently get commissions for people signing up for these insurance plans. All right, so let's do a knowledge check for this. So we have Gregory. He is 35 years old and he's single. Gregory's mother, Helen, lives with him. She's age 63. Her only income is $14,500 in wages, which she used to pay for her medical and other personal expenses. Gregory's brother, George, is 30 years old. He is totally and permanently disabled. George has some income and it comes from non-taxable supplemental Social Security income. Gregory provides all of the costs for keeping up the home for himself, Helen, and George. In terms of health insurance, Gregory purchased his own plan from Marketplace and received advanced premium tax credits to help pay for it. Helen's health insurance is from TRICARE and George's insurance is from Medicaid. So when he does the form for completing the form 8962, what is Gregory's tax family size going to be? Will it be 1 because it's only Gregory that's covered by a Marketplace plan? 2 because Gregory can actually claim George as a dependent? Helen's income is too high for her to be able to be claimed as a dependent. Is it 2 but just because Helen is older than Gregory and so she can't be as dependent? Or 3 because there are 3 of them in the household? All right, think about those options for a moment. And the answer is B. So it asks about tax family size, which basically means the people that you can claim on your tax return, which includes himself. Helen can't be claimed because her income's too high. Her age doesn't matter in this case, but because of that reason, she's not a part of Gregory's tax family, right? George, because he is totally and permanently disabled, he can be claimed by Gregory on his tax return. All right. So now let's talk about tax benefits for education, right? So we see quite a lot of this because, right, the vast majority of our taxpayers that we help are students here at college. So let's talk about that. All right, we're going to go through an overview, talk about terms, talk about eligible expenses, and talk about scholarships and grants. All right, so the idea, right? Hey, go to college, we'll give you money off your taxes. That's basically the idea here. So we have education credits that can be used to reduce the cost of higher education by reducing the amount of tax that you pay. So they're based on higher education. So this is not through high school, so not K through 12. It is above that. So it is bachelor's degree, master's degree, doctorate degree. And it's based on qualified education expenses that are paid during the tax year. And we'll talk about qualified education expenses as well. The 4012, there's not really any changes for the OB3 for this one this year. So for us, the 4012 is a good, very useful reference. It's got 3 or 4 different tables of like, these are the different credits, like comparing the one credit versus the other credit, like what things are eligible and what things are not eligible. They're not the same. So highly, highly recommend use the 4012, look at those tables when you're trying to figure out the credits and what's eligible and what's not. So there are 2 main education credits. The first one is called the American Opportunity Credit, or AOC. The second one is called the Lifetime Learning Credit, or LLC. Only one of those 2 credits can be taken for any individual student. However, a tax return can have both credits if there are more than one student. So Maria is going to school, she's getting, she claims the American Opportunity Credit. John is going to school, he's married to her, he claims the Lifetime Learning Credit, for example. Right, that would be totally legitimate, but I cannot claim both the American Opportunity and the Lifetime Learning Credit in the same year, the same tax return. There are kind of general rules that apply as well as specific rules for each credit. Again, there are some other benefits to look out for as well. We don't often see them, but they are theoretically out there. There's a qualified tuition plan, a 529 plan. The idea is like a savings account, right? You or a family member or a friend puts money in this 529 account. It grows tax-free. And when you take it out, as long as you spend it on qualified education expenses, you don't have to pay any income tax on it. So like a retirement account, but for going to college. If you were in the military, you can earn veterans benefits, which will pay for a lot of college expenses. Likewise, some employers will pay for college expenses as well. So publication 4012 again has lots of really good stuff. All right. So there are two ways that education expenses can affect a tax return, right? You can have taxable scholarship or fellowship for grant income, right? That is going to be reported as income. It is going to be reported as the student's income, no matter who claims the student. So even if they're being claimed as a dependent and they get a taxable scholarship, that student is going to have to report that taxable scholarship as their own income, unless if it's not used as a qualified education expense and they're not a degree candidate. Then there's two tax credits again, American Opportunity and Lifetime Learning Credits. Is calculated on the return of the taxpayer who is qualified to claim the student as a dependent. So a full-time student who's under age 24, claiming themselves as a dependent and claiming the American Opportunity Tax Credit are only entitled to the non-refundable part of the American Opportunity Tax Credit unless their parents are no longer living. All right, so basically this is a way to try to make sure that, once again, taxpayers are not kind of gaming the system a little bit. All right. So theoretically, if you, like, we're not going to be doing our interviews, right? But our students are going to come in, they're going to have all of their income documents. Hopefully they will have a 1098T, which is a tuition statement from their school. If they don't have that, they will likely be able to access their student account, which would show, like, these are all of the charges that I had during the year from my school. These are all of the payments that I made. These were all of the payments that were made for me on my student account. We're not going to be doing those. So most of them will come in, but they will have those forms, even though we're not going to do that 13614. So let's talk about a few of the terms. So an eligible institution is generally any accredited public, nonprofit, or private college, university, vocational school, or other post-secondary institution. It is eligible to participate in the Department of Education FAFSA student loan program. The school will know, of course, right, if they're eligible or not. They all want to be eligible. They want people to be able to get loans to come to them. There is a database here that you could go to if there were ever any question about it. But generally, right, for the schools that we're supporting, yes, they're going to be eligible institutions. An eligible student is the taxpayer, spouse, or a dependent who is enrolled in one or more courses as either an undergraduate or a graduate student. All right. I think that I don't know why I have that there. I'm going to take out those stars there because those don't really apply. All right, for qualified education expenses. So this is the big one here, and this is the one that can like vary a little bit. So qualified education expenses include tuition, fees that are required for enrollment, and course materials that the student was required to buy from the school. All right, some things are qualified education expenses for the determining scholarships and fellowships, which are those things that we talked about. Generally, we get a lot of questions about like, oh, hey, I bought a computer. I had to buy a computer for school. does that count, right? And the response is generally no. Unfortunately, it doesn't, right? And the thing that we would say is, all right, I need you to show me on the course enrollment, like required materials, that it says, you know, this particular model or whatever of computer is required to be purchased for everybody that is participating in that class. Or you are required to purchase like XYZ computer to enroll in this program. Now, probably there are a few that would actually have something that would qualify, right? But most likely that's going to be something like a computer science degree where you have a certain computer that you need, possibly. It's generally just a student going out and buying a computer, even though kind of from a practical perspective, they sort of really need a computer to go to school. That is not going to be a qualified education expense because it's not required for them to enroll or receive credit for their classes for their degree program. Qualified education expenses do not include things like room and board, like sporting event tickets, health insurance, transportation, parking fees, research, travel, and other things that are not required for enrollment. All right. And these are the list of qualified education expenses for determining tax-free portions of scholarships and fellowships. The criteria for the American Opportunity Credit are slightly different. And those are different as well from the criteria for the lifetime learning credit. This is why those tables are really, really good in the 4012, because it kind of lists out, hey, this is what qualifies, this is what not qualifies, this is where you have to buy things, or this is where you can buy things anywhere. All right. So a grant, scholarship, or fellowship is going to be tax-free or excludable from income only if the student is a candidate from a degree at an eligible institution. Blah, blah. A scholarship is tax-free only to the extent that it doesn't exceed the qualified education expenses, right? So if somebody gives, they say, Maria, we love you. We're going to give you $10,000 to go to school at the University of Minnesota. And tuition is $15,000, I can say, yeah, that's great. Woohoo. I have a tax-free scholarship, right? That is a qualified scholarship. It's excludable from my gross income. I still have to come up with $5,000 on my own to pay for everything and then pay for my room and board and all of that. But thank you for giving me that $10,000. Now let's say, hey, Maria, congratulations. We're going to give you a $10,000 scholarship. We're going to have you attend, low-cost university in Minnesota. There, the tuition is only, $2,000. That's great, right? And I'm like, super good, right? Then I can use $2,000 for my tuition, and then I'm going to spend $8,000 on my rent and food, and I'm not going to have to pay anything out of my pocket to go to school. Well, but only that $2,000 is going to be qualified. That $8,000 is not a qualified education expense for my scholarship and fellowship. That means that $8,000 is going to be taxable income for me. Occasionally, scholarships can say, hey, Maria, we're giving you $5,000 for room and board. And so then I can't say, oh, no, I want to use that for my tuition. I have to spend it on room and board. It is going to be automatically taxable for me. Occasionally, PhD programs in particular will say, oh, we're going to give you a fellowship, but I'm sorry, but you have to work for this fellowship. So that should, if they have to work for it, that is supposed to be reported as wages on a W-2 rather than as a fellowship, right? A fellowship should be non-service. You don't have to do anything to earn that, to receive that money. If you are required to work, then that is service and it is, taxable income, but it's wages rather than scholarship or fellowship. All right, here is what the 1098T form looks like, or 1098T form looks like. The universities issue it to students. If the student is over 18, they're an adult legally, so the student or the school is not going to give it to their parents without the student's permission. Although the student has the information, generally that's going to be used by the parent to file their tax return. By itself, a 1098-T is often not going to be enough to actually calculate the correct education credits. The students will also need to look at their financial statements to see how much they paid in fees, see if they received any scholarships or fellowships, see if they paid any separate expenses, that were not paid through on their student account. Sometimes schools, just to make life really tricky, they send those to people who are non-residents as 19098T. Right? Remember that non-residents are not eligible for any of the education credits, so they can't use this form. Sometimes the schools will track residency status, and they're really good about sending it only to residents. Sometimes they try to track it and they are wrong, and so they don't send that form when they should. If that happens, students can request those forms if they are a tax resident. They need to follow up with their school to find out why they didn't get that form. Usually it's because the school has some bad information about their visa and visit entry data. All right. So a student account statement, right, is going to show tuitions and fees, other expense payments that are received by third parties as well as themselves. Often that can show bookstore purchases, and the American Opportunity Credit will generally allow those things. It can also be used to determine which fees to qualify. So if students rent books, right, a lot of time now they do electronic textbooks. So they just pay one fee and that covers all of their books. That's a really good way to see how much that is if it's on their student account information. All right. Sometimes if they say, oh yes, if you rented this book or bought this book from this university bookstore, that would qualify. For some education credits, if they went and bought that book from like Amazon, that would not qualify for the education credit. So where they buy the books can matter, or where they spend the money can matter. So 4012 is your friend once again. All right, let's talk a little bit more about eligibility here. So to claim an education credit, the following must be true. So the taxpayer cannot be claimed as a dependent on somebody else's tax return. The student must be the taxpayer, their spouse, or a dependent of the taxpayer. So the dependent does not claim the education credit. The taxpayer cannot be married filing separate. Their adjusted gross income must be below the limit for their filing status, and they cannot be non-resident aliens for any part of the tax year. If they were non-residents, but they elected to be treated as residents for the full year, then they are resident aliens for the full year. So that goes. And the AGI limits on this one, right? Like this is a very complicated area, right? They're different for each of the different types of credits, lifetime learning and American Opportunity Credit. Okay, so the taxpayer who paid the qualified education expenses for an eligible student attending an eligible education institution can claim the education credit. Qualified education expenses paid by a dependent or by a third party for that dependent are considered paid by the taxpayer who can claim the student as a dependent. If the student isn't claimed as a dependent, only the student can claim the education credit, no matter who paid the money. So like if the grandparents are paying the money and the student isn't claimed as a dependent, then the student is the one that can claim that education credit. So basically the idea is like the grandparent gave a gift to the student and then the student spent the money on those expenses. All right, so let's talk about the American Opportunity Credit. So the student must attend an eligible institution. It covers qualified expenses, tuition, fees, books and supplies. 40% of their credit is refundable. So maximum credit is $2,500 per student based on $4,000 of qualifying expenses. And it's actually kind of a weird calculation. So it's 100% of the first $2,000 in expenses and then 25% of the next $2,000. It can only be claimed for 4 tax years. You have to be enrolled at least half time as defined by the eligible education institution. You only need to be enrolled for 1 term though. You don't have to be enrolled for the entire calendar year. You just have to be enrolled at least half time for one term. If you have a felony drug conviction, you are disqualified for claiming the American Opportunity Credit. You can't claim it if you're married filing separate. It's only available if the student had not completed the first 4 years of post-secondary education before the tax year. So this can be slightly problematic if students took college classes while they were still in high school. They might have completed from the number of credits perspective, 4 years, freshman, sophomore, junior, senior, for 4 years of post-secondary education before they've actually done 4 tax years of claiming the credit. All universities will generally have a page on their website that talks about like the number of semester hours that have been completed to be considered a freshman or a sophomore or a junior or a senior. All right, if a student is under the age of 24 and claiming the American Opportunity Credits, none of the credit is going to be refundable if they're under age 18 or age 18 and half of the year and their earned income was less than 1/2 of their own support, or if they were a full-time student over 18 and under 24 and their earned income was less than 1/2 of their own support, and they have at least one living parent and they don't file a joint return. So basically, if they can be claimed as a dependent, they are generally not going to be eligible for the refundable portion of the tax credit. So they can still reduce their income down to 0, but they don't actually get any money back. All right, it's unusual, but not impossible for students, international students, to claim the American Opportunity Credit. Generally, right, students coming on FTA visas are going to be non-residents for the first 5 calendar years. They must be a resident alien to claim the credit, which doesn't occur until they're in their 5th academic year. Usually, they're only eligible if they haven't completed their first 4 years of post-secondary education before 2025. So students that were here for like elementary or secondary education, high school, and became resident aliens can generally get it, but generally, otherwise, they will not be eligible for it. This is one of the big mistakes, the big dollar impact mistakes that non-resident students make when they file as residents, because they say, oh, yes, right, nobody can claim me as a dependent, and I'm paying all of this money in tuition, and here's my 1098-T form, and it's my first 5 years. So, hey, I get a $1,000 refund for a refundable portion, perhaps. All right, lifetime learning credit. So this is a non-refundable credit. So the American Opportunity Credit was at least partially, mostly refundable. The lifetime learning credit is non-refundable, completely non-refundable. It has different criteria, right? It covers undergraduate and graduate courses to acquire or improve job skills. So you don't have to be a degree-seeking student to be eligible for the lifetime learning credit. The maximum credit is $2,000 on a $10,000 qualified expenses, and it's a straight 20%. So no like different brackets, which is really nice. You must attend an eligible institution. Qualified expenses include tuition and fees. It includes books only if you bought them for the educational institution as a condition of enrollment. So if you have to buy the books from the school itself, then you can include them. That is not usually or not a common criteria. A lot of schools are much more flexible about like where you can buy books. This is a per return amount. Expenses from students can be combined to increase the qualified expenses to that overall $10,000 maximum. Remember, like only students, a student can only claim one. So you can't say, oh, we'll take, $4,000 of expenses for the AOC and then the other $6,000 towards the lifetime learning credit. It's only one thing per student. The other thing here that's important is you can be less than a half-time student, so you don't have to be going to school essentially full-time. All right. When you look to try to determine like which one should you choose, right? Because there's a choice here. Do you take the American Opportunity Credit or do you take the Lifetime Learning Credit? And it is perfectly okay. And we want to help our clients take the credit that's going to give them the best tax outcome, right? To reduce their tax the most, have them pay the least, get the largest refund. within, as long as they're staying within, filing a true, accurate, correct, and complete tax return. So when we try to figure this out, right, the first question, right, does the American Opportunity Credit apply? Generally, that is the best credit, right? Are they eligible for it? Do they have $4,000 of education expenses? Yeah, let's go for that one first. No, well, you can start to get a little bit crazy. You can say, oh, I have this taxable or tax-free scholarship, but rather than do that, I can say, oh, I actually am going to count that as income, and maybe I'm going to pay 10% on that income, but then I can count my expenses towards the American Opportunity Credit, right? Where I've got 100% credit for that first $2,000. If the American Opportunity Credit does not apply, then we would go to the lifetime learning credit. Do they owe tax? Yes, that's great. Okay, we can do the lifetime learning credit to reduce their tax down to zero. If they don't owe any tax, then the lifetime learning credit doesn't mean anything, right? Because they don't have any tax and it's a non-refundable credit. Okay. They should have that form 1098T. They can request it if they don't have it. If they don't have it and they submit the return without it, they should expect a letter from the IRS requesting documentation to support what they sent in, right? That student account statement is going to be the big one. The taxable scholarship or grant is reported on the return when the amount of scholarship exceeds their qualifying education expenses. Tax credits are reported based on having education expenses that are more than any scholarships that you receive. All right, the student will claim the credit if they can't be claimed as a dependent. All right, here's one of the comparison tables. Publication 4012, section J is the education credit section. So I would definitely, again, recommend everybody look through there. I know that this is like a huge amount of detail. You don't need to remember all of this, right? Remember that if you go to college, there may be some credits that you're eligible for if you're a resident for tax purposes. We're going to go to our 4012 to try to figure out what they are. All right. So when we try to figure out when things are, what eligible expenses are, we want to make sure that we have this 1098T, right? They have to try to get the 1098T. They can still file the Form 863. That's the one where for the education credits. They have to provide substantiation for all of this stuff, right? A copy of their student account would be helpful. They're not going to send it in to the IRS, but they're going to wait for that letter and they'll send it in when the IRS sends them the letter. All right. If there is an adjustment on that 1098T that says that the university, for whatever reason, they made some adjustments, if there is a number in that box number 4, that is going to be out of scope for us. So kind of cut off box number 6 there as well, but basically boxes 4 or 6, we can give them some reference information, but we're not going to be able to help them with those pieces of it because it does add another level of complexity onto the return. All right, so when we calculate what expenses would qualify for these credits, right? It's going to be expenses paid during the calendar year. However, there's also like a little proviso, which says you paid the money before the end of December 31st, 2025, and it was for spring 2026 classes. As long as that spring semester, that class period starts in the first 3 months of the following year, that qualifies for the 2025 tax, qualifies as education eligible expenses. You're going to have to subtract any scholarships or fellowship grants that you received from your expenses. Remember, if you have more scholarships, then you have taxable scholarships. If you have less scholarships, then you have eligible expenses that you may get a credit on. All right. One thing to note, right? Qualified education expenses do not include insurance, medical expenses, room and board, transportation, similar personal, family, or living expenses, right? This is true even if you have to go pay those to the school as a condition of enrollment, right? You have to live in the dorms when you're a freshman. You're required to pay the university to live in the dorms. Even though that's a requirement to enroll, that still does not count as a qualified education expense. Likewise, international students, you're required to have health insurance to be here as a student. Because it's insurance, it still is not qualified as an educational expense. Sports, games, hobbies, non-credit courses, those generally, if they don't count towards your degree, they don't count as eligible expenses. However, if you are required to take like a physical education course for your degree, and this particular course had a, I don't know, a park fee of $15 for it, then that would be eligible, right? But it has to be required for your degree. Comprehensive or bundle fees, sometimes they combine everything together. If they do that, ask the university to tell you like what is required or what is not, what's going to be eligible or qualified education expenses or not. Generally, I haven't seen problems with them like combining it all to like obscure what is eligible and what is not. So I don't think that this is generally going to be a problem for us. All right, here are a couple of examples of modified to remove individual personally identifiable information student accounts at the University of Minnesota, right? So this has things like, oh, you got a scholarship waiver, tuition waiver. You had these capital fees, collegiate fee, enhancement fee, stadium fees, all of these other fees. You paid all of this money, right? Some of these things are definitely eligible expenses, right? Tuition, non-resident undergraduate school tuition, that would be an eligible expense. UPass is a transportation pass, right? So you can take the bus around the Twin Cities for free or just with this one cost. That would not be an eligible expense. Student health benefit plan fee, right? Paying for student health insurance. That is not going to be an eligible expense as well. This undergraduate tuition school fees, right? You dropped a course, so they charge you tuition and then they took it away because that was paid for, right? You can't count that even though you got a refund on it, right? You have to net that out to say, okay, yes, I did not really spend that $29.52 in tuition. It was dropped, I got my money back. All right. So here's a couple of examples, right? So if we look at this, this is a pretend student, Ethan, going to Washington State University. So his 1098-T shows that the university received payments of $9,900 for tuition and related expenses. That's what's in box 1. And the university liked Ethan. They gave him a little bit of money. They gave him $5,360 for scholarships and grants. So based on this, Ethan has $4,540 of eligible expenses, right? He paid more in tuition and related expenses than he received in qualified scholarships or grants. All right. Very important, right? We can't double dip on the expenses. We can't count them in one place and count them in the other place. So for example, if you have expenses and you get part of those are paid for scholarships and fellowships, right? You can't say, oh, I had $9,000, but oh, I had this scholarship that was also, paid for qualified expenses. You can say, oh, I had $9,000 of expenses and $5,000 of scholarship income, or I had a net $4,500 of expenses, but you can't basically double count that. All right. All right, so another way to look at the math, basically documentation on all of it. All right, so let's talk about scholarships and fellowships for a few minutes. So a scholarship or fellowship is like an amount that's paid to, provided for the benefit of a student at an educational institution to aid in the pursuit of their studies. A fellowship is usually the same thing, except that it can also be to aid in the pursuit of their study or also their research. So it can include amounts for tuition or other fees that are paid to the student to allow them to do that study or to do that research. It can also include things like value of contributed services or accommodation, right? It can be a stipend that pays for your room and board, or it can pay for your room and board directly. It can be money that they give you for, to travel to a conference or something like that. So it can be all of these types of things that they might give you money on that would be enabling you to get your degree or to pursue study or pursue research. All right. So scholarships and fellowships can be treated basically in two ways for tax purposes, right? When we did the non-resident tax, there were three ways. So here we're going to do two ways because we don't have treaty exemptions generally for residents for tax purposes. So for us, it's going to be either excluded for income if it's a qualified scholarship, or it's going to be included as a taxable scholarship. All right. So, oops, lost AJ for a moment. All right, we're back. So let's look at like the reversal of this for Ethan's situation, right? So previously we said Ethan had a 1098T. This time, his payments for tuition were $9,900, but the scholarships or grants were $13,400. So Washington State loved Ethan. They said, come here, please. We'll pay all of your tuition and we'll give you some extra money to help pay for your room and board. And so he is going to have scholarship or fellowship income of $3,500. It's going to be taxable income. It's going to need to get reported on his federal income tax return. All right. So you can choose, right? So there's this fabulous little shell dance that you can do, right? Where you say, oh, well, I'm going to reduce my income, my scholarship income as much as possible so that I will only have to pay tax on the smallest amount of income possible. However, because of the way the math works on some tax credits, particularly the American Opportunity Credit, sometimes you can say, oh, okay, I'm going to pay tax on a little bit of that scholarship so that I can report some eligible expenses for the American Opportunity Credit because that credit starts off at like 100% for that first $2,000 of eligible expenses. So if the scholarship allows it, they can kind of like do this, I call it kind of a little bit of a shell game, right? You're balancing act, like say, oh, which one is the best option? So you can't like double dip. You have to make sure you're reporting all of the income, all of the expenses, but you can choose how you allocate those expenses or how you allocate the scholarships to whether you count them as a qualified or for living expenses, which would be non-qualified. So there can be a few times where they can't really choose. Basically, if the terms of the scholarship say that it can only be used to pay some things. So for a good example for that is like a tuition waiver, right? A tuition waiver is when they say, oh, just don't worry about paying that part of your tuition, right? Which is super great, it's a scholarship. But you can't like choose to use that somewhere else. A tuition waiver can only be applied to tuition because they're waiving the tuition, they're taking it off. You also can't choose an alternate treatment when it's not reasonable that the amount of grant or scholarship amounts included in income could have been spent on the student's general living expenses. So for example, if the student or parent had no income or had no loans to pay the tuition, or the amount of living expenses is small and it won't cover the grant amount. So not that it really would make a lot of sense, but right, but let's imagine that you had a scholarship of $50,000 to pay for tuition of $50,000 and living expenses were $15,000, right? You can't say that, oh, that full $50,000 was all taxable scholarship income because that's not reasonable, right? That was basically way more than the living expenses that you would have. All right. Okay. So generally, if somebody is eligible for the American Opportunity Credit and they have education expenses in excess of their scholarship or fellowship grants, it's really easy, right? They don't have to do anything. If the qualified education expenses minus scholarships is greater than or equal to 4,000, you exclude the scholarship straight away, you still get the maximum American Opportunity Credit possibility, right? So in this example, right, there's no reason, like right here, there's no reason to report any of that scholarship as taxable income because you're already going to maximize the maximum amount of American Opportunity Credit because you've got $4,000 of education expenses above your scholarship amounts. If it's not quite that simple, then it can get a little bit more complicated. Really kind of the best way to do it, the software will sort of help you choose which one is going to be the best. And it's going to be based on the student's tax rate, how much income they have. If they're a dependent, then it's going to be based on their family's total income, their family's tax liability, like where do they fall in the phase out range as well. It gets quite complicated. So I can say some like general rules of thumb, right? And this is like rules of thumb. So it's going to be right a lot of the time, but definitely not all of the time. So usually when the qualified expenses minus scholarships is less than $4,000, you should include enough scholarship as taxable income to get at least that first $2,000 of expenses for the American Opportunity Credit. Beyond that, often you will claim up to enough expenses, include scholarship and income, to claim that $4,000 expenses, but only if that increases your refund. So it gets a little bit complicated, and really the best way to do it is to kind of play with the numbers to see. And remember, right, this is in most cases, it's not going to like always be guaranteed no matter what. You should report $2,000 in expenses or anything like that. Okay, when a student is a dependent, and that's right, that's a lot of our folks that we're going to see, right? They're going to be dependents. The best option, ideally, right, would be to have them do their returns together, right? So they're not going to all come into our tax clinics most likely, so they can work together. They can talk to each other outside of the tax clinic so that they prepare their returns together so that they maximize the credits and their overall tax liability as a family is reduced, right? We can't make them do that, right? They're going to do whatever they're going to do. That is fine. But we can encourage them to try to work together if they're willing to do it to try to maximize the credits, reduce the amount of tax they're going to owe as a family unit. All right. If they file, like if the student files on their own first, they're eligible to be claimed as a dependent, but they file on their own. And they say, no, I can't be claimed. I'm not being claimed. I take my credit. I get my $1,000 refundable American Opportunity Credit. Yay, right? The student's like, yeah, man, $1,000 cash back. Super cool, right? But their parent is saying, oh man, right? Like I could have gotten a $2,500 tax credit, right? So you got $1,000 in your pocket, but you cost me $1,500 as a family to, to not get that credit on my tax return. It can also cause challenges when the family tries to claim that child as a dependent. They may get kicked out, so they can't electronically file their return and have to paper file or file amended returns. The student may have to file an amended return then. So it becomes complicated and a mess. So in an ideal world, they're going to all talk to each other and do the thing that saves everybody the most money. And if not, we will counsel them that they should consider that, and then they're going to do what they're going to do. All right. If a dependent is required to file a tax return and they have taxable scholarship income and their other unearned income exceeds 2,700, there is this extra form that's required, this Form 8615. It's called the kiddie tax form. The idea is that Americans, right? People, they all try all of the tricks to get around paying taxes. So once upon a time, parents would give their children lots of stock. They would say, hey, congratulations, child, you now own thousands of shares of Meta or something like that. And so because the children's income was so much smaller, right, that those dividends would be taxed at a much lower rate. And so the parent would kind of get used to that money and not have to pay tax on it at the parent's tax rate, which would have been much, much higher. To prevent that from happening, there is this Form 8615, the kiddie tax, which basically says dependents that have more than a certain amount of unearned income have to file this form, and they would potentially have to pay this tax. So people like that are out of scope for us, thank goodness. Okay, and I just talked about this. Okay, all right. So taking a step back, for education credits, families may be able to increase their total refund or reduce the amount of tax they owe by paying some tax on a scholarship or grant if they have one and increasing their education credit. In some cases, you can report scholarships as taxable income to that student to maximize those. For Pell Grants and other scholarship expenses that allow students to use them for living expenses, right? Do they have $2,000 of education expenses? Do they have $4,000? Find what's going to be best for the client. Find what's going to be best for the client and their family, right? Taxable scholarship or fellowship income is reported on the return if they have more scholarship income than education expenses, right? We definitely will have a lot of, not a lot, we will definitely have some people that have that situation. All right. Okay. So that is a whole lot of mess on education expenses and credits. All right. So we're going to go next. So we're going to talk about finishing the return. All right. So this is one area where the model that we typically use is different than the traditional VITA model. So in a traditional VITA model, right, so the clients came in, they filled out the 13614C, they had all their income documents, the tax preparer reviewed that 13614, they did an interview to ask additional questions, they confirmed all of their documents, they entered all of the information in the return. Now we're here. So we would double check that 13614 versus the documents that we have versus what we have entered. A quality review would be done by another IRS VITA volunteer, right? And that VITA volunteer has to be certified at the same or higher level of tax certification required. So if it's a return that has basic tax certification elements, then the tax preparer has to be at least basic and the quality reviewer has to be at least basic. If it's got advanced criteria, then the tax preparer has to be advanced and the quality reviewer has to be advanced. We always do advanced, so we don't have to worry about that piece of it. There are other criteria, there are other certifications, right? There's a Puerto Rico, there's a military, there's an international. We're not doing any of those things, so we would never see any of that stuff. We're not going to help with that. But if you were doing the VITA model, you want to make sure, yes, as a quality reviewer, I am certified, I can support that return, right? It's got to be somebody else. You can never review your own return. You would talk about your refund or payment information. How is that going to happen? You're going to enter your information. You're going to print copies of the return. You're going to sign your e-file authorization. The IRS, the VITA volunteer is going to e-file the return. If it gets rejected, we're going to fix the issues based on whatever the client says, right? This is where that 1095A could get a rejection. All right, for us though, that's the traditional model. And if you're going to do if you're in the pilot here at the U of M, you want to do that alternative volunteer readiness check process, we'll be doing this with you, right? So you'll do the return, myself, or possibly another very experienced quality reviewer. We would be there to review it with you when you're done. So we'll go through everything, all of the documents. We'll go look at the return, make sure everything is correct. So we know that what's happening for the taxpayer is going to be 100% right. But when we get to our regular clinics, right, the FSA model, right, the taxpayer is double checking everything themselves, right? We're going to try to encourage them to get a review. We say, hey, yeah, when you're done, raise your hand. We'll come double check everything is right, but we can't make them do it, right? The taxpayer is going to determine their method for how they're going to get a refund or how they're going to make a payment. They're the ones that click the button to send it off to the IRS. They can email us for help with fixing it, or they can come back into the tax clinic and can help fixing it. But we're not actually in the software doing anything, right? The client is the one in the tax software doing all of those pieces. All right. So when we're completing the return, if the taxpayer is getting a refund, right, we want them to do direct deposit. It's faster, it doesn't move, all those kinds of great things. We also have this new fund, right, this executive order that says the IRS is not supposed to do paper checks. There are supposed to probably be some allowable exceptions and processes to request an exception, but that's not yet really been defined. How the money gets to you is also not really defined, right? Will they, under certain circumstances, if you ask really nicely, will they still send a check, or are they going to send it on a debit card, right? We don't know how it's going to work. The one thing we can probably say is that almost certainly it's going to add some extra time to get your money. So definitely it's going to take longer. Direct deposit, if you can, is going to be the way to go. You can split your refund between 2 or 3 accounts if you wanted to do that. All of the accounts need to be banks that are here in the United States. So, but it can be between multiple different accounts. That's no problem. If you have the earned income tax credit or additional child tax credit, remember that refundable portion of it, the IRS does not send out refunds until at least February 15th, right? This is mandated by law to make sure that they do some additional checking to help prevent fraud, right? Because those are some of the credits that are most subject to fraud. And then the IRS website, the Where's My Refund, is a really good place to check what the status is of the refund. The IRS also has an app if you want to use that, the IRS to go, not to GP, sorry, to go, IRS. There we go, okay. All right, for the direct deposit stuff, you need the bank routing number and account number. So the bank routing number is always 9 digits. The account number can be any number of digits, and then you have a little checkbox for whether it's a checking or savings account. Double, triple check this one. This is super important when you have somebody there, right? The IRS doesn't have anything to interfere or stop or delay if the routing number or the bank account number is wrong. It's going to put that money in there, or it's going to try. If that bank account doesn't exist, then it'll reject, it'll error out, and the person will fix it. But if it's a real bank account, that money is going to go into somebody else's bank account. And yes, they can get it back, but it's going to be a pain. It's going to take them a while to get that refund back. So double, triple check. That's really important. All right, if they owe money, right? Just like with the non-residents, there's different ways to pay. They can do direct debit from a bank account that's here in the United States. They can send a paper check. The IRS will still be happy to take paper checks. They can do other electronic payment options. They can go onto the website and pay with a credit card, but they charge them the fees 1%, 2%, 3%. They can also do an installment agreement. The thing to know here, right, is that you have to file and pay your taxes by April 15th. You can get an extension of the time to file your taxes, but you can't get an extension of the time to pay your taxes. If you don't pay your taxes on time, the IRS will start charging you penalties and interest because you haven't paid the money when it was supposed to be done. If they owe a lot of money and they're not really able to pay, we can help put them in touch with the low income tax clinic, which is basically a legal tax clinic that can help them either navigate the agreements, installment agreements, or payment option plans for that, or work with them if they're not going to ever be able to pay it to get the amount reduced. None of those processes are quick, by the way, 6 months to a year kind of processes. So if a taxpayer does want to delay filing their forms, they can file the Form 4868. It's an extension of time to file their forms. Remember, not an extension to pay, just to file. That grants them until October 15th to file their tax returns. All right, they can do that online. There's no problem about it. They can just file that request. We do try to encourage them to try to get through their returns sooner, right? We only do tax clinic appointments through April 15th. We do other support after that so they can still get help, but it's not appointments, so it's not quite as nice. The software is available through the end of October, so it did just go down here just under a month ago. If there is a balance owed, they should pay as much as they can, because all of those amounts, the failure to pay, the failure to file, the interest, they're all based on how much money you owe. So if you're going to get a refund, you won't actually owe a failure to pay or fail to file penalty, because there's no percentage on the amount that you owe. You can request 120 days to pay a tax bill in full using the online agreement. There's no fee for that. However, penalties and interest do continue to add on until you pay everything off. All right, there is a longer agreement that you can request that has fees to set that up. And again, those interest and penalties, right? It's a racket. They just charge you until you pay. So when you do all of those preparation things for the federal return in terms of making a payment or getting a refund, you can do that same thing for your state income tax returns. Similar process. You say, okay, I want my refund directly deposited. As far as I know, no states have had any shenanigans about not sending out paper checks. So those are still definitely a viable option for taxpayers if they want to get their refunds that way. All right, so let's just talk about a couple of things about learning from the quality review. So, right, so the first thing when we think about what a quality review is, right? Every volunteer, oops, pardon me. All right, so every VITA return is going to be reviewed by an experienced preparer in the traditional model, right? We can't like for the traditional VITA model, right? Like we physically as volunteers, we have control over the software. So we can make sure, right, that return can't be submitted until 2 sets of good eyes have gone through everything to make sure it's right. For the FSA sites, right, we can't do that, right? They have control of the software. So we can't like step in front of them to make them, to force them to let us review it. We can encourage them. We can say, yes, please do. We'd love to take a look at it, but we can't make them do it. During a quality review, during the traditional model, right, the reviewer is going to look at the Form 13614. They're going to look at the income documents. They're going to look at the tax return to make sure everything is correct, right? So we're not going to have, as an FSA site, we're not going to have that 13614. We're going to have income documents and finished tax return, and then we're going to need to talk to the taxpayer to ask questions for things that are maybe not covered or that we don't have documentation for. In most cases, we're going to look at the completed return, right? So we're not going to go through the software. The software, right, it has, God, hundreds, maybe thousands of places where you can click and select this and do that, right? We can't go through all of those things to make sure everything is correct. What we're going to do is we're going to look at the finished return forms themselves and say, okay, I know the income, I know this, I know that. Are these forms correct? And we're going to practice this. Right now you're practicing on creating the forms, and then we're going to practice on reviewing the forms to make sure you can say, all right, I have this income document and this information. Is this return correct? Because that is a very important skill for you. That's where a lot of your value to our taxpayers comes in. Generally, there should be questions. This is a part of this process, right? Hey, tell me about this. How do you do this? Oh, I saw you worked 2 jobs, or whatever it is. All right. Generally, you're not gonna, like in a traditional model, right? The return is gonna be printed and the final results given after the quality review is complete, right? We don't wanna tell them, hey, congratulations, you got a $5,000 refund until we've done that quality review, right? Because what happens if that refund changes, right? If it goes up to 6, then they're gonna be happy. But if it turns out that, well, actually they weren't eligible for that credit, you have to take it away. And so it's really just a $2,000 refund, right? 2,000 is still a really great refund, yay, right? But the taxpayer is going to be really unhappy because they're like, oh, but I thought I was supposed to get $5,000. So if we were doing the traditional model, or for those people that are doing the traditional model, right, we're not going to give them the final result until after we've done that quality review because we know that it can change. All right, for the FSA site, right, they're going to see it from the beginning. They're going to see what their numbers are, and that's fine. And it'll change when we do the review if there's something that changes, and it is what it is. We're there to make sure that that return is correct before they submit it. All right. So when you have a quality review, right, if you're talking to a client, right, say that like they're reviewing the returns to make sure everything is correct, right? Everybody makes mistakes, right? We want to make sure taxpayers review it, volunteers get reviewed. Make sure, like the most important thing is that we do it right for our clients. And so, we don't want to be wrong, but right, we would rather be wrong and catch it than pretend it's all okay. Because that means that the IRS is going to catch it or somebody else is going to catch it later when it's much harder for the taxpayer to fix. All right. If you are the preparer and you're doing a traditional review, right, talk to the reviewer. Let me know. If it was me, let me know, like, okay, we had this. I'm not so sure about like this particular thing, or like, oh, so they were eligible for some education credits. So if you can like double check those to make sure everything is right, that would be great. Right? If I find something or the reviewer finds something, make sure you understand why things needed to be fixed, right? What was wrong? Did we just like click the wrong button in the software, which could happen? Did we miss entering this form? Or do we not understand the eligibility? Like whatever it is, we want to make sure that, yes, this mistake happened this first time, but it's not going to happen in the future. And you can explain that to the taxpayer, right? Don't try not to, as best you can, feel self-conscious or worry about it, right? Everybody makes mistakes. It's a learning opportunity. That's why having 2 people to check is good. That's why we do so much practice, because we want to make sure that we're eligible, right? Remember, for us in the FSA side, right, like our preparers, right, this is like the first time that they've probably ever prepared a tax return. So they have no idea. They're going to be very worried that it's correct. So be kind to them, right? It's okay that they made mistakes. That's why we're here. We're going to double check it. Let's get things fixed so that everything is good before we send it, right? If things aren't clear, go back, get help, do research, ask, right? We don't expect you to have everything memorized. We do expect you to like know the concepts so that you can search for it in the 4012 or the 4011, or search for it on the IRS to find, oh, publication, blah, 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 has information about education expenses and scholarships or whatever it is, 970. All right, when you're done, ask, Do you have any questions, right? We want that open-ended. Give them a little bit of time to process everything that's been said. See if they have any questions or concerns about their return or about any of it. And then say thank you for coming, right? Come back and see us next year. We are happy to help you, right? That applies to everybody. Okay, I'm going to mention a few extra services with things we can talk about with our clients, right? If they have a balance due, how do we prevent this from happening next year, right? They can update their W-4 form to increase the amount that gets withheld from their wages. If they have income that's not covered by withholding, such as self-employment or some scholarship or fellowship income, they can make estimated payments, right? They send in money. Hey, I know I'm going to owe taxes. Like, here's $200 for now. If they're getting a really big refund, right, that's fabulous, but maybe we should change our withholding so much isn't taken out of every paycheck and you get more money during the year in your paychecks rather than just like one big, huge lump sum at the end of the year. Sometimes they need a little bit of help for like advice regarding record keeping, right? If a taxpayer is self-employed, there are some really good resources out on the IRS website. There's a couple of other ones from trusted sources that we have about business expenses and documentation, about keeping records and how to make sure that you've got the information you need. So if that happens, you right now can look, the 4012 has some information. If you just go out to the IRS website, you can say, Schedule C, search for Schedule C, or say business expenses, and it's got some publications that have a lot of good information about that. Sometimes they are having problems for different years or they need more help. So that's where the low-income taxpayer clinics come in. Basically, they help if there's it's called a controversy with the IRS, essentially like a disagreement or some issue with what the IRS is saying. So a big balance is due that can't be paid. If they had a prior year tax return, like, oh, I got a letter from the IRS, but I kind of ignored it or lost it or never responded. It's never a good idea. But if they did, it is what it is. All we can do is kind of move forward from where we are today. The LITC is a free service. We have contacts at the one at the University of Minnesota, and we can put people in contact with other LITCs around the United States. So we can help connect them with free, qualified legal tax assistance if they're having a problem with the IRS. In addition, there is an organization called the Taxpayer Advocate Service. They're a part of the IRS, but they're sort of like a separate part of the IRS. And they will also represent taxpayers in disputes with the IRS. So like if things like are not working the way they are supposed to with the IRS in particular, you can request help from them and they will assist you. I have actually done that. It does work. It's not very quick, but it does work. So it is a viable option for people to go to if they're having problems. All right. And with that was a whole lot of credits for the resident world. Does anybody have any questions? All right. If you do, you are welcome to send me an email as well. Happy to talk about these in more detail. Holy buckets. I am going to make this really quick. Let's make that quick. Let's try to go here. Okay. We're going to go to Link and Learn. We're going to go to Practice Lab. Link and Learn is still not live. So, all right. Train Pro Web is where we go. And then we log in. Okay, go to the practice area. All right. Let's just do a pretend client. 1, 2, 3, 3, 2, 1, 4. 1, 2, 3, 3, 2, 1. All right. I'm going to just kind of show you where the menus are for the credits really quickly once we get through these beginning things. Testing, because I'm very original. Oop, that is not a real year. Okay. We're going to just leave this 32 home. All right. There we go. Continue. Okay. No dependents. Continue. All right. So if we had dependents, that's where they would go. All right. Here's where we would enter all of our income, right? Then we go to deductions. And in the deductions, although it says deductions on the high level, it is actually where the credits menu is. So credits is right there. And basically, right, it has the huge list of all of the credits. So child and dependent care credit, right? This has the information about like who provided the care. And then you would enter the information about who received the care, like what is the child's information. All right, education credits, right? We would select a student. We would say, yes, we have our 1098T. No, this isn't entered, right? We would enter the information for the university. I'm going to do pretend information, right? You'd enter the information from the boxes, right? Okay, I had, you know, $10,000 of tuition paid, $4,000 of grants and scholarships. I paid like other direct expenses paid by me, $100, right? You would ask screening questions for the American Opportunity Credit, which we would answer like, no, we haven't claimed it. Yes, I was enrolled at least half time. No, didn't complete the 4 years. No drug things. Ooh, look at this. Are you eligible for the refundable portion? Answer no if 1, 2, and 3 apply to you. So 1, were you under age 18? Full-time student over age 18 and at least income. Yes, we would have to say no. All right, there we go. See, it does the work, does some math saying, hey, we think that's the best one for you. There you go. All right. And then there's additional credits down here. So yes, so that's kind of where the credits menu is. So if we go back, again, it's in the federal section under deductions, which is a terrible place to put it, but credits. Okay. Signing in, so on and so forth. Okay. All right. Let's do this. I'm going to skip Dear Iris. We're going to go here. I'm going to maybe add that. Okay. So one more time, I'm going to ask if anybody has any questions before we kind of wrap things up for today.
Yes.
All right. What is your question?
My question is, once we pass the certification and once we start working, how would the virtual works?
Sure. Yeah. So imagine that you are the taxpayer, or rather, you're the volunteer and I am the taxpayer. We are going to be in, so we'll have a Zoom meeting for the remote event. The volunteers will be in their own breakout room. And then whoever is managing the event will put a client in with you in your breakout room. And you can talk to that client. The client can share their screen So you can see the software, you can see their return, you can see their documents, and you can ask them questions. You can show them, oh, yes, okay, go back to federal, go to deductions, go to credits. Okay, now click on this. Yep, okay, now you're going to change this number here based on whatever.
Oh, so the taxpayer is going to do their own tax returns.
Yes, so that is the FSA model, is that the taxpayers prepare their own returns and we assist them with that. So generally, we will be answering questions. They'll come to us and they'll say, okay, like, I don't know, like, where do I enter my 1098T form? I don't know where to enter that. And you would say, sure, you're going to go to the federal deductions credits, education credits. That's where you're going to enter it. Or they're going to say, all right, I've got my return done, but I don't know if it's right. And you say, okay, well, let's get a PDF of your return and let's look at your income documents and let's go through it to see if it's correct.
Okay, yeah. I really don't know what other with this position. Is there any other positions related to tax returns done by volunteers? Any other position?
Yeah,
Or
so
just
yeah. So if you're wanting to kind of you do the more traditional model where like a taxpayer comes in with their documents and then you prepare the return for them in the software, and then
yes.
somebody else reviews it. Um, I will say that so we're piloting that for the volunteer readiness check, but that's not kind of our standard procedure. There are other VITA tax clinics that do that. And I can send you the names of some other ones and some contact information if that's kind
Oh,
of the model that you would rather have.
sure.
Sure. Yeah. You can just think about it and send me an email if you'd like. How does that sound?
All right, good. Thank you.
Sure. No worries.
I'll do that. Thank you.
Perfect. All right. Does anybody else have any questions? All right. So then let's just do this really quick. So here's the website for Moodle. Whoa, that is not the website for Moodle. Oh my gosh, Maria. I will fix that before I send it out. All right. That was the Moodle link from last 2 years ago. All right, when Lincoln Learn Lives, I will let everybody know. Right now, we're waiting for the IRS. As far as Moodle goes, so you should have gone through modules 1 through 5 or modules 1 through 5 already. Module 6 is credits. Module 7 is education benefits. Those are available for you to do now. Module 8 is practice return assignments. I don't have those all updated yet, so that's going to go live tomorrow for you. So those are the 3 things that you need to do. Those will give you practice in all of the areas that you will need that will hopefully kind of have you well prepared to take the IRS advanced test. And with that, that is everything for today. I will, let's see here. I'm going to stop the share. I'm going to stop the recording.